if I told you your bank account has a leak? That every single day, the money you work so hard for is silently losing its power. This isn't some conspiracy theory, it's happening right out in the open. Governments are even admitting it. They call it inflation. But what they don't tell you is just how bad the problem really is. This great debasement of our money is creating a once in a generation wealth shift, a quiet financial crisis that punishes savers and rewards those who know the new rules of the game. So, which side will you be on? Because the smart money, the institutional money, is already making its move. They're in a historic flight to safety, and it's pushing a revolutionary new asset toward a price that will shock the world. Stick with me because what I'm about to show you isn't just a prediction. It's a warning, and it's an opportunity to understand why your dollars are dying and how this is paving the way for Bitcoin to hit $120,000. To get what's happening, we first need to look behind the curtain of the financial system we all live in. We need to talk about the money in your wallet and your bank account. That money, whether it's the US dollar, the euro, or the yen, is called fiat money. The word fiat comes from Latin, meaning let it be done. Basically, fiat money has value only because a government says it does. It's not backed by a physical thing like gold, it's backed only by trust. For decades, this system was the foundation of the global economy. It gives central banks, like the US Federal Reserve, incredible power. They can manage the money supply, set interest rates, and flood the system with cash during a crisis. Sounds good, right? In practice, though, this power has been abused, leading to something called currency debasement. Historically, debasement was a physical thing. Take the Roman Empire. Their main silver coin, the denarius, was once a symbol of pure economic power, made of about 4.5 grams of pure silver. But as the empire's costs piled up, from wars to fancy building projects, the emperors ran short on silver. Instead of raising taxes, which nobody likes, they found a sneakier solution. They started mixing cheaper metals like copper into the silver coins. The coin looked the same, but its real value plummeted. This started slowly under Emperor Nero. By 270 AD, a coin that was once almost pure silver reportedly contained only about 5% silver. The result was a disaster. There were more coins, but each was worth less. Prices for everyday goods shot through the roof, causing hyperinflation that helped cripple the Roman economy. Fast forward to today, the tools have changed, but the game is the same. Instead of clipping coins, modern governments debase their currency in two main ways: insane levels of government spending and a practice called quantitative easing, which is just a fancy term for creating new money from nothing. Let's look at the spending. For fiscal year 2025, the US government is projected to spend around $7 trillion dollars while taking in only about $5.2 trillion dollars. That's a deficit of nearly $1.8 trillion dollars in just 1 year. To cover that gap, the government borrows money by issuing treasury bonds. But who buys all this debt? That's where the second part comes in: the central bank. The Federal Reserve, through quantitative easing, QE, can literally create new digital dollars and use them to buy these government bonds. This pumps new money into the financial system. It's the modern version of the Romans mixing copper into their silver coins. The supply of money explodes, but the amount of stuff to buy in the economy doesn't. This imbalance means every dollar you have is now a smaller slice of a much bigger pie, so it buys less. This isn't a mistake in the system. It's a feature. It's how the government pays for things without the political fallout of raising your taxes. The scale of this is hard to wrap your head around. The US national debt is projected to keep growing faster than the economy itself, on a path that could see it hit 118% of GDP by 2035. Every single year since 2002, the federal government has spent more than it earned, adding trillions to its debt. This cycle of spending, borrowing, and printing is the quiet crisis of our time. It's a hidden tax that's systematically destroying the value of your money. This might all sound like big abstract economics, trillions of dollars in confusing policies, but this silent crisis directly and painfully impacts your daily life, your savings, and your future. This isn't about numbers on a spreadsheet, it's about the real world value of your money. The most obvious effect is the loss of your purchasing power. We all feel it. It's that nagging feeling that your paycheck just doesn't go as far. It's the sticker shock at the grocery store when your bill is 20% or 30% higher than a few years ago for the same items. It's the soaring cost of housing, school, and healthcare that makes you feel like you're on a treadmill, running faster just to stay in the same place. This isn't in your head, it's inflation, and it's the direct result of currency debasement. Think about it this way: you trade hours of your life for dollars. When trillions of new dollars are created out of thin air, they aren't creating new goods or services, they're just diluting the money that's already out there. Every new dollar printed makes every dollar you've saved worth a little less. Imagine you have a bucket of water representing all your savings. Now imagine someone is constantly pouring more water into it. Your share gets smaller and smaller. That's what's happening to your money. It's a hidden tax that nobody votes on, and it hits the most responsible people the hardest, the savers. If you're someone who works hard and diligently puts money in a savings account, you are on the losing end of this game. A savings account might pay you 1% or 2% a year, but if the real inflation rate, the rate your purchasing power is actually dropping, is 5% or higher, your savings are actually losing value every day. You're going backward. The system, as it's set up now, punishes savers and rewards debtors. If you have a big loan like a mortgage, inflation helps you by letting you pay it back with cheaper and less valuable dollars. This doesn't just affect the price of milk and gas. It creates huge bubbles in asset markets. When people realize their cash is losing value, they dump it into other things to protect their wealth. This sends a flood of capital into stocks, real estate, and other scarce assets. It's why the stock market can hit all-time highs while life gets harder for the average person. It's not that every company suddenly became more valuable. It's that the dollar we use to measure their value is getting weaker. This creates a dangerous wealth gap. Those who own assets see their net worth explode. Those who rely on a paycheck and cash savings get left behind. The traditional path of building wealth by simply saving has become incredibly difficult. You're now being forced to become an investor, taking on risk in the market just to keep the wealth you already have. This is the agitation. The system has become a game where the rules are rigged in favor of those closest to the money printer, and the financial security you thought you were building is slowly dissolving. If this is starting to make sense and you're feeling that disconnect between market headlines and your own wallet, make sure you subscribe and hit the notification bell. We're here to break down these complex topics and give you the information you need. The first step is awareness, and we're just getting warmed up. When people finally realize that cash is a melting ice cube, a predictable thing happens: the flight to safety. Everyone starts scrambling for a place to park their wealth, somewhere it won't be eaten away by inflation. For generations, the playbook here was simple. When currencies weakened, you bought safe haven assets. The classic example is gold. For thousands of years, gold has been the ultimate store of value. It's scarce, it lasts forever, and it has value all over the world. A central bank can't just print more of it. It's the original hedge against debasement. Another traditional safe haven is real estate. Land is scarce, they aren't making any more of it. Owning property has historically been a reliable way to protect and grow wealth. As the currency gets weaker, the price of real estate tends to go up, preserving your purchasing power. But in the 21st century, these old school solutions are showing their age. They're analog answers in a digital world, and they have some big drawbacks. Take gold. It's scarce, sure, but it's not easy to move around. Try taking a bunch of gold bars across a border. It's a logistical and regulatory nightmare. It's also not easy to spend. You can't exactly shave off a piece of a gold bar to buy a coffee. Plus, the gold market isn't perfect. Its price is heavily influenced by paper derivatives and futures contracts, which might not always be backed by physical gold. Real estate has its own issues. It's the opposite of liquid. Selling a house can take months and comes with huge fees. It needs constant maintenance, and you have to pay property taxes forever. Most importantly, it's not truly yours. Your ownership is subject to the laws and taxes of the government where it's located. It can be taxed, regulated, or even seized. So here we are at a turning point. The old lifeboats are leaky. The very policies driving this flight to safety are also creating a world that needs a new kind of safe haven asset, one that has the scarcity of gold but can be sent across the world in an instant, one that's immune to censorship and seizure. The world is desperately looking for a digital, sovereign, and incorruptible store of value. And it's in this search that the problem of dying dollars meets the solution of Bitcoin. This is where the story pivots. We've laid out the problem: a global financial system built on currencies that are designed to be debased. We've shown how this directly hurts your wealth, and we've seen how the old safe havens aren't quite cutting it anymore. Now, we get to the solution, a solution born from the ashes of the 2008 financial crisis, designed specifically to fix these problems. That solution is Bitcoin. To really get why Bitcoin is being called the ultimate hedge, you have to throw out what you've heard in the headlines. Forget the get rich quick narrative. We have to look at what it actually is: a new kind of money. At its core, Bitcoin is the world's first decentralized digital scarce asset. Think of it like a digital gold, but with some major upgrades for the modern world. Let's break down what makes it so revolutionary. First, and most importantly, absolute scarcity. Unlike the US dollar, which can be printed into infinity, Bitcoin has a fixed supply. There will only ever be 21 million Bitcoin. This number is a law, enforced by a global network of computers. It can't be changed by any person or government. This makes Bitcoin the hardest money ever created. We know its exact supply schedule. We know that every 4 years, the amount of new Bitcoin created gets cut in half in an event called the halving. This programmed scarcity is the direct antidote to the endless printing of fiat money. While your dollars are designed to lose value, Bitcoin is designed to preserve it. Second is decentralization. Bitcoin isn't controlled by any single company or government. It runs on a network of tens of thousands of computers all over the world. No central authority can freeze your account or reverse a transaction. This makes it incredibly resilient. To shut Bitcoin down, you'd have to shut down every one of these computers at the same time, an impossible task. With Bitcoin, if you hold your own private keys, you have true sovereign ownership of your wealth. Third is censorship resistance. Because there's no middleman, no one can stop you from sending or receiving Bitcoin. If you have an internet connection, you can send value to anyone, anywhere, anytime without asking for permission. This is a massive power shift back to the individual. Fourth, Bitcoin is durable, portable, divisible, and verifiable. Like gold, it lasts forever. But unlike gold, it's incredibly portable. You can store millions of dollars worth of Bitcoin on a tiny device the size of a USB stick. It's highly divisible. Each Bitcoin can be split into 100 million smaller units called Satoshis, and it's easy to verify. Anyone can check transactions and the total supply on the public ledger, the blockchain. People often say, but Bitcoin isn't backed by anything. That shows a misunderstanding of what gives money value. The dollar isn't backed by anything either, except a government promise that's being broken by debasement. Bitcoin is backed by something far more real: mathematics, cryptography, and the enormous energy securing its network. It's backed by its perfect scarcity and the fact that it's a monetary asset that can't be arbitrarily inflated. This is why the digital gold analogy is so powerful, but also incomplete. Bitcoin has the scarcity of gold, but it's also programmable, instantly transferable, and gives its owner true sovereignty. It's an insurance policy against the mismanagement of our traditional financial system. It's a peaceful exit. The theory is solid, but is it actually happening? Is the world really waking up? The evidence is overwhelming, and it's what builds the case for why Bitcoin is on a path to $120,000 and beyond. This isn't just a random number. It's a target supported by powerful economic trends, institutional buy-in, and simple supply and demand. First, the macroeconomic drivers. The US Federal Reserve has adopted a dovish policy, meaning they've been cutting interest rates. Lower rates make borrowing cheaper and signal to investors to move out of cash and into other assets to find a return. Bitcoin is a prime candidate for that capital flow. The dollar index has already seen one of its worst drops in decades this year, falling around 10% in the first half of 2025 alone. Analysts expect more rate cuts, which would only add fuel to this fire. While the supply of money is expanding, the supply of new Bitcoin is contracting. As we covered, the Bitcoin halving cuts the creation of new coins in half every 4 years. This creates a massive supply and demand imbalance. According to some reports, institutional demand through new products like exchange-traded funds has, at times, outpaced the creation of new Bitcoin by a factor of 7 to 1. When surging demand crashes into a fixed and shrinking supply, the price really only has one way to go. And that demand is no longer just a theory. It's here. 2025 has been the year of institutional adoption. The floodgates are open. The approval and wild success of spot Bitcoin ETFs from giants like BlackRock and Fidelity have legitimized Bitcoin as a true asset class. For the first time, pension funds and corporate treasuries can get exposure to Bitcoin through the same regulated channels they use for everything else. As of the end of the third quarter, hundreds of public and private companies hold billions of dollars worth of Bitcoin on their balance sheets. This isn't just retail hype, it's a strategic move by the world's most sophisticated investors. Kathy Wood of ARK Invest calls Bitcoin a rule-based, quantitatively limited global monetary system, pointing to its security and scarcity. This institutional rush is creating a supply shock. The amount of Bitcoin available to buy on exchanges is shrinking as it gets moved into the cold storage of long-term holders and ETFs. Finally, the market data shows professional traders are positioning for a huge move up. Options data from platforms like Deribit reveals that one of the highest areas of open interest is for call options. bets that the price will be above a certain level, with a strike price of $120,000. While some firms like Galaxy Digital have walked back more aggressive targets, they've reaffirmed a $120,000 target, citing these massive institutional flows. This tells you the smart money sees this as a very real possibility. This isn't just a story, it's a convergence of powerful forces. Governments devaluing their currency, a revolutionary technology with perfect scarcity, and full blown adoption by the largest financial players on Earth. This is the evidence. This is the bull case for $120,000. Understanding the why is the first step. But the next logical question is how? How can an average person actually take part in this and protect their wealth? The good news is it's easier than ever, but it requires a mindset of responsible, long term thinking, not reckless gambling. First things first, start small and do your own research. Never invest more than you're willing to lose. Bitcoin is powerful, but it's also volatile. The goal here isn't to get rich quick, it's to preserve your wealth over the long haul. A proven strategy for building a position is dollar cost averaging, DCA. It just means buying a fixed dollar amount of Bitcoin on a regular schedule, like $50 every week, no matter the price. This takes the emotion out of it and smooths out your average cost over time, so you don't have to worry about timing the market. The next vital concept is self custody. One of Bitcoin's superpowers is financial sovereignty, but that only works if you hold your own private keys. When you leave Bitcoin on an exchange, you're trusting them like a bank. To take true ownership, you need to learn to move your Bitcoin to a personal wallet where only you control the keys. Hardware wallets are small physical devices considered the gold standard for security. Remember the saying, not your keys, not your coins. This is a journey of education. This video is a starting point, not the final word. Read books, listen to podcasts, and follow respected educators. The more you understand the fundamentals, the more conviction you'll have to hold on through the ups and downs. Think of this as a long-term savings technology, a lifeboat in a sea of sinking fiat currency. We've seen how the money you earn is being systematically devalued by governments, a modern repeat of the same mistakes that brought down empires. We've seen how this hidden tax is quietly stealing your savings and making it harder to get ahead. And we've explored why old safe havens like gold and real estate just aren't enough anymore. Then we found the solution. Bitcoin, a decentralized, secure, and perfectly scarce asset designed for this exact moment. The evidence is clear. With central banks printing money and institutional giants leading the charge, demand for Bitcoin is exploding while its supply is locked in. This incredible imbalance is what builds the data driven case for a $120,000 Bitcoin. We're living through a massive financial shift. The system has already forced you to be an investor by devaluing your cash. The only choice you have left is what you choose to invest in. Will you stick with a system that's programmed to drain your wealth, or will you explore an alternative that's programmed to preserve it? The choice is yours. Take this information, continue learning, and start taking control of your financial future. If this message resonated with you, share this video with someone you care about. The more people who understand what's happening, the better off we'll all be. Thanks for watching.